Is your 401k worth less than you would like? Now, I'm sure many people would like to see their 401ks much higher than they are, but unfortunately, that wish is just not a reality for many people. Even though 401ks across the United States now total over $12 trillion, there are still people that are way behind in saving for a good retirement. This keyword there obviously is good. It is not the fault of the 401k system, though. It is generally the fault of the saver or the investor. Now, why do I say that? Well, such things we have talked about in the past, like not rolling over your 401k when you go to a new employer or taking early distributions for what you thought was an emergency. Workers who are 45 to 60 years old now are known as Generation X, and they have an average balance in their 401k of $192,300. It is not that much higher for baby boomers who are at or are very close to retirement and have an average balance of only $249,300. At our firm, we do a 6% distribution rate. We've done that for our income accounts over 25 years. And even at that rate, a retiree based on the baby boomers' average balance would only receive $1,245 per month in retirement. The 401k is a long-term investment, and it does require some sacrifice and discipline. But in my mind, there's no reason why a 25-year-old, let's say starting today, earning $60,000 a year should not become a 401k millionaire. Besides the obvious of not investing enough or taking money out during the accumulation phase of your retirement, well, poor investment decisions are a big problem as well. If a 401k investor can average even 7 or 8% per year and invest 15% of their salary, which would include the company match, a $1 million 401k is easily attainable. People who become too emotional in their 401k when they say a drop of 10, maybe even 20%, they then panic and move everything to the money market or bonds, forgetting that retirement is 5, 10, maybe 15 years or further away than that. We also tell people that even when you retire at 65, you still have at least another 20 or 30 years potentially of investing and should not be all in bonds or money markets during that retirement phase. If you have a good advisor, well, they should be there for you when times get difficult, which they will, and not just tell you to stay the course, but explain to you in understandable terms of why your investments may be down now and why they are still the right investments for the long run. Target date funds have been pushed by many as an easy way to hit your retirement goal, and nearly 60% of plan participants were invested in a single target date fund in 2024. That is an increase of 50% from just 10 years ago. The problem with target date funds is the fees can be excessively high, and even if you pick the correct year for your target retirement date, you may find that you're invested too conservatively and might not have enough exposure to good quality equities or stocks, is what most people refer to them as. At our firm, Wilsey Asset Management, we do not recommend target date funds, but more of a managed approach using value investing, which has proven to be a great investment strategy for many years. A warning for 401k investors is there is a lot of pressure to allow private investments into 401k plans, and I believe these will benefit the fat cats on Wall Street more than the individual investor. I highly recommend that you avoid these high fee, high risk investments. I'm Chase Wilsey with Wilsey Asset Management. If you like these videos, be sure to give it a like or comment, and feel free to check out our other YouTube videos and weekly newsletter for the latest economic news, expert analysis, and market insights.